In the context of new highs, especially on the US equity market, but also in Europe, many commentators speak about a bubble of equity markets. Now, is this right? We would say no. What is a bubble first? A bubble is clearly a valuation of capital markets, which is not really relevant to the economic facts. But the bubble is also self-fulfilling. In other words, if I take a taxi and the taxi driver tells me which shares to buy, clearly this is a symptom of a bubble. Private investors today are still very, very reluctant when it comes to equity investments. They have been burned over the last 10 years, and we speak today with our private investors much more about property investments and fixed income rather than equity investments. The driver of valuations are threefold. One, inflation, very important. Second, it's actually earnings growth, what each company does deliver in terms of benefits. And last but not least, it's monetary policy. It's a liquidity in the capital market circle. We see very much a different picture in the US. In the US, we clearly have monetary policies which will ebb out in October. They will be less accommodative. We see also an inflation in the US, which has been growing over the last 3 months from 1.1 to 2.1%. And clearly earnings growth are very high today, but corporate margins are also very high. So we are not necessarily convinced that this is sustainable. However, there's a lot of merger and acquisitions going on. We have seen $1 trillion of merger and acquisitions in the first half, and this gives a stabilization to the market. So in short, clearly, there are a lot of headwinds in the US market, but upside seems to be limited from here. Now, if we speak about the European equity market, here we have a lot of accommodative monetary policies being reinitiated recently, negative rates, credit money being pushed into the circle. But inflation is not at all a topic in Europe. We have actually the other problem. We are afraid about deflation, so too little of inflation. The major issue for investors in Europe is the absence of strong earnings growth. We have very soft earnings growth in Europe, and that puts a lot of headwind on European valuations. The key assumption for our position is that we believe economic growth will happen in Europe and is sustainable. We don't believe, for example, that the second quarter growth will be negative. These figures will come out around mid of August, and it would be a shame if Europe cannot grow from here, because that the impact would be very substantial. Corporate earnings would come down. Financing, equity, capital markets financing would probably vanish slowly but surely. And at that stage, I clearly would reconsider my position on European equities. For any investors, my advice would be aware that long-term lead indicators are very key here, because Europe, despite that we are positive, might still drift off its economic growth track. Once this happens, revisit your position, but for now, stay long equities.